Good morning and welcome to the Killik & Co podcast. This week, the European Central Bank has published the minutes from its last meeting, and as expected, there is some more detail about the tapering back of quantitative easing. I'll just draw your attention to this quote here from the meeting reports, which says that a view was put forward that conditions were increasingly falling into place that would allow the intensity of monetary policy accommodation to be adapted and would provide an opportunity to scale back the Eurosystem's net asset purchases. So that shows that the European Central Bank is confident in the progress of the European economy, and they think that the economy could stand to be without the level of quantitative easing that is currently going ahead. There was also a lot of talk about keeping interest rates in the region lower for longer, and again that is definitely a good thing for European stock markets. So over the week we have seen European stock markets move higher. On the more negative side for Europe this week, there has been a lot of tension between Spain and Catalonia. It's very uncertain what is going to happen there. There has been a lot of violence and protests, so it is a very uncertain and very tense political situation. Unsurprisingly, we have seen Spanish stock markets moving slightly lower. So this chart here shows the Spanish index, the IBEX 35, over the last year. As you can see, there has been a small decline over the last week, but actually not a particularly large move, and that does imply that people are not overly concerned about the impact that this will have on Spain over the longer term. We've also been looking at 10-year government bond yields in Spain. Those have moved slightly higher over the last week, which does demonstrate that bonds prices have fallen. That shows that some investors have pulled money out of the country, but again, the move is not significant, and therefore it does suggest that people are not overly concerned at the current point in time. We've also had PMI numbers for September being published this week. That stands for Purchasing Managers Index, and it is a very closely watched measure of economic progress. It's a survey that's undertaken every month in which a number of purchasing managers are asked whether their business conditions have stayed the same, improved, or got worse. And all of those responses are compiled into a score. The score is between 0 and 100. So if the score is 0, that means that every single person said that business conditions had worsened. If the score is 100, that means every single person said business conditions had improved. If it's 50, that means that the business conditions had stayed the same. Normally the score is between about 40 and 60, but really anything over 50 is considered to be a good thing and a positive for the economy. So this week the numbers for September were published. If you have a look here, you can see a summary of some headline numbers for some of the major countries. The global average for September was 53.9, so quite a long way over 50, so that's definitely a good thing. The Eurozone was really a standout performer this month, and the number for the Eurozone was 56.7. In particular, Germany had very good numbers. Those came in at 57.7, and even the UK was at 54, so slightly above the global average, and very positive considering how uncertain things regarding Brexit are at the moment. So I think the market is very happy with those PMI numbers this month. And also this week, some negative data on car sales for the UK has been published. In September, car sales fell 9.3% in comparison to September the year before, a very negative number. That is the 6th consecutive month of falling car sales, and it's particularly negative to have a negative number for September. September is when the new car registrations come out, and therefore it's normally a very strong month for car sales. To have such a large fall is definitely a concern. It could point to concerns over the economy as a whole. But actually it could also be relating to the government's new law that says no petrol or diesel cars will be able to be sold in the UK after the year 2040. So perhaps people are a little bit uncertain about that. So we will be watching car sales numbers closely over the coming months to see how they perform. Moving on to the week ahead, we do have 3 Killik & Co stocks reporting. Those are Marston's, Wells Fargo and Citigroup. That's it from us. Have a great weekend and we'll see you next Friday.